Hi guys, welcome back to my channel. Kelvin here. In investing, there are 3 methods to how you can deploy your money. The everyone's favorite, dollar cost average, the rich guy's favorite, lump sum investing, and the newbie's favorite, trying to time the market. Obviously, there's only one clear winner to this strategy, and that's trying to time the market. Just kidding, that strategy only works in theory. No one can time the market, especially not me, who can't even time boiling the egg just the right amount. That leaves dollar cost average and lump sum investing. Between the two, which is better? Many articles will tell you to dollar cost average into the market. But what if I told you that the best strategy is not dollar cost average, but rather lump sum invest? So in this video, I will discuss about why lump sum investing wins, and despite so, why there's still so many people telling us to dollar cost average. And I'll also share which strategy I personally use. So let's not waste any time and let's start right now. Before that, just in case you are new to investing, I want to give a quick intro about the 2 methods so that you don't blur later on. Let's start with lump sum investing first. I'll explain it in LOL terms so that even a 12-year-old can understand. In LOL, you can use 4 main skills, right? Each skill will cost you a bit of mana to use. So in lump sum investing, you just immediately use all the 4 skills at once. Now, all your skills are on cooldown, and you have no more mana left. There's nothing else you can do other than to pray that you manage to kill the enemy while waiting for your mana and skills to be available again. Got it? Just in case you didn't get it, lump sum investing is just you all in your money into the stock and pray that the stock will go up. So imagine you have $10,000, you YOLO all that $10,000 into the stock. If the stock goes up, voila! But if the stock goes down, then you GG lor. You just have to suck thumb and wait for the stocks to recover. Okay, yeah? Okay, that was lump sum investing. Next, I'll quickly explain dollar cost average. Again, I will explain it in LOL terms. Remember, we have 4 skills. In dollar cost average, instead of using all your skills at once, you just use 1 skill. Wait a while, use another skill. Wait a while, then use another skill. You give it time to let your skill cool down and mana to recover. So that's dollar cost average in LOL terms. In adult terms, dollar cost average is just you splitting your money and slowly investing into the stock. Stock goes up, you buy a bit. Stock goes down, you buy a bit more. After a while, you'll get the average price of the stock. So dollar cost average versus lump sum investing, which strategy is better? Well, it depends on the market condition. Let's start with the first scenario. The stock is going up or chonging. Imagine you're in March 2020 all over again, which let's hope that it won't happen ever again. The market was crashing like nobody business and is now at the lowest point. All of a sudden, you have the money and the balls to lump sum invest into stocks like Tesla. If you had done so, you would have at least 7x your money. Assuming if you have held them till now, of course. But if you were scared like me and decided to just dollar cost a bit in, over 1 year, your average price would have been around $300 to $400. And you will have only 2x your money and be like, "Aiya, I wish I bought more, yeah." Same for many other stocks that were going up like Zoom, Amazon, Apple, and many other godlike stocks. So in summary, when the stock is going up, lump sum investing wins. And speaking of winning, this video is brought to you by Skillshare. Skillshare is an online learning community with thousands of online classes for all sorts of topics. They got tons of classes on personal finance, stock investing, and options trading. I'm always looking for ways to level up myself all the time. And right now, I'm taking a class called Productivity for Creators, Starting a Successful Side Hustle by Ali Abdal. In this class, he shares tips and strategies which are useful to creators. For example, once in a while, I might lose motivation to create a video. Yes, I get that from time to time, because I'm not a god. But I learned from this class that you can try to make things more fun, to try to motivate yourself or make simpler videos so that it is easier to achieve your goal. So because Skillshare is sponsoring this video, the first 1,000 to click the link in the description will get a free trial of Skillshare Premium membership. After that, the annual membership is less than $10 a month, which is super affordable for all the things that you can possibly learn. You could watch all the tutorials you want, whenever you want. So go click the link in the description. Try it out and you will be able to start a whole new world of constantly learning new skills. With that being said, let's get back to comparing the 2 investing strategies. Which brings us to the second scenario. The stock is going down. Imagine this situation. The stock was going up, then finally you bought in. Then somehow, the stock knew that you bought in and be like, "Hey, bluff you one." Then starts going down and down. I don't know about you, but this has happened to me every single time I bought the stock. It's like a curse. Let's use NIO as our example. If you have lump sum invested here at all-time high, thinking that it can still go higher, but no, it went down instead. you would have lost almost 50% on paper. And right now, you and your money are still crying to sleep every night. But if you had just dollar cost average, throw in some money every few days, you will be able to bring down your average cost to around $30+, and you will be almost in the green now. So in summary, when the stock is going down, dollar cost average wins. Third scenario, the stock is going sideways. There are a few times in history when the market has been going sideways for a very long time. A very famous example is the lost decade, where the S&P 500 was trading sideways between 1999 to 2009. If you have been very swayed and lump sum invested your money right at the beginning of the lost decade, you will have to wait 10 long years for your money to give any returns. But if you had just consistently dollar cost average over the 10 years, your average price will have been around here, and you will be in the green most of the time. By the way, this lost decade is not exclusive to only US. Singapore's STI ETF has also been stuck in this endless loop since 20 years ago. Japan market experienced the same thing, Italy market too. So unlike what most people say, stocks do not always go up, but they always go right. In summary, when the stock is going sideways, dollar cost average will win. So these are the scenarios that can play out. Dollar cost average wins when the market is going sideways or going down, and lump sum investing wins when the market is going up. But we are more interested to know which method wins most of the time. Let's check out the study by Vanguard, titled Dollar Cost Averaging Just Means Taking Risks Later. It shows you some very interesting stuff. If you look over here, over many years, it was found that lump sum investing always wins 2/3 of the time. It doesn't matter what kind of portfolio you choose, whether it's 100% stocks or 100% bonds, lump sum investing always wins. It's like you playing Street Fighter. No matter which character you choose, your friend will always use Dalsim and long leg kick you till you lose. We are no longer friends now, by the way, so it would seem that lump sum investing wins most of the time. But hold up, there's a plot twist. If you look carefully, it says that even though lump sum investing wins most of the time, it's only by a small amount. In US, lump sum investing only won by 2.3%. In UK, it's 2.2%, and Australia is only 1.3%, which to be frank is not really that much. So even though lump sum investing wins most of the time, I would say that no matter which method we choose, we will end up with almost the same returns over the long term. In the article, they also point out something important, your emotions. Here it says risk-averse investors may be less concerned about averages than they are about worst-case scenarios, as well as the potential feelings of regret that will occur if a lump sum investment were made immediately prior to market decline. Back to the Tesla example, imagine you have FOMO in at all-time high at 800+, then it dropped all the way down to 500+ range. Would you have used the newbie strategy of buy high, sell low? Or would you have held on? I bet that there are quite a few of you who had paper hands and just sold at the lowest point, only to have the stock went back up. Either way, during the few weeks, you must be feeling sad and that you have made the wrong decision to invest at the wrong time. But instead, if you have just dollar cost average in, you will have been less emotionally affected if the stock goes down. Then you will have most likely held on, and when the stock recovers, you will be in a much better position. So what's my take? Should you use dollar cost average or lump sum invest? The simple answer is to use dollar cost average. It's almost impossible to time stunts in LOL, and even harder to time the best price to buy the stock. So I might as well don't even try. You won't time the market wrongly if you don't time the market. But
¿Por qué no los dos?
We can actually go one step further, which is what most of the pro investors do, including our god of investing, Warren Buffett Koko. You see, in most cases, we can just dollar cost average to get an average price. Maybe we buy a bit, like $1,000 every time. Meanwhile, you keep putting some money aside into your war chest. This is your special money where you only use it when there's super big sale in the stock market, like when the stocks were crashing super hard in 2020. When that happens, if you suddenly see stocks that you like are crashing, like maybe Tesla crashing for no reason at all, if you have done your research, you believe in the company, you know that long term this company will do well, and this crash is just caused by people having paper hands. In that case, you can just take out your war chest money and maybe lump sum invest a larger amount. There's a saying, riches are made in recession. When stocks finally recover, like they always do, you will be rewarded well, assuming that the stock is a good stock lah, of course. So all in all, even though it has been shown that lump sum investing gives a higher return, it's not A or B option. You can use both strategies because both have their benefits. When times are normal, just dollar cost average consistently. When times are scary, take advantage of the situation and use lump sum invest. If you can follow these rules, I will bet that you will do well over the long term. And that's all for today. Which strategy are you using? Dollar cost average or lump sum invest? Let me know down in the comments below. Like, share and subscribe as I'll be posting new videos every Monday and sometimes Friday.